Hello, welcome to another edition of Nucleus Investment Insights. Sorry for the slightly late start. Today we want to have a look at 2025 predictions. So we're going to have a run through and look at just a number of the newspaper headlines, and then sort of have a look at some of the likelihoods or not of some of these coming to pass. And also just, I guess, a quick look at some of the sentiment factors and things like that we're looking at around the world at the moment. So with no further ado, we'll jump straight into it. Just a quick reminder that everything here today is general advice in nature, is not personal financial advice. If you do want to have personal financial advice, feel free to look us up and drop a line, and we can have a chat to you about your own personal circumstances. And so in terms of the objectives for today, I want to start with some of the forecasts from professional forecasters. So this is sort of something put together by one of the US government organizations. And so they look through at expectations for professional forecasters, or the blue chip forecasters for 2025. And so we're looking at GDP growth somewhere between 1.9 and 2.5. CPI somewhere between 2.1 and 2.8, unemployment between 4 and 4.6, and the 10-year Treasury yield somewhere between 3.8 and 4.5. So I guess that's sort of the starting point of saying, well, things look pretty good from that perspective. The only thing I do want to highlight is coming back to the very next chart, which is showing how accurate these have been for the last sort of 30 odd years in terms of these forecasts. So they've been running it for some time now. So in terms of GDP growth, the number of years where GDP did come in, real GDP did come in between the average top and bottom there was actually only 44%. CPI was a bit better, 56, but we're still not talking much better than coin tosses at that level. And then unemployment and 10-year Treasury yields were both basically a coin toss, slightly worse than a coin toss. So and that's talking about it coming within a range. But so obviously things do change. You do get some downturns, or you get recessions, you get pandemics. There's a whole bunch of things that sort of pop into that, which can throw those numbers out. But I guess what I want to do is just make sure that we're taking these forecasts with the expectation is this is what markets are pricing in, or this is probably what markets are pricing in based on based on these surveys and expectations. And then the question is really about whether those expectations are going to move in what direction and what's causing it, and sort of what are the things we really want to be watching for. So it's more about saying, okay, so we've got this set of forecasts out there for economic data. We just need to take that with a, don't lock it in. It's it's sort of a guide, but it's probably more of an indication of what's being priced rather than what's actually coming. If you look at, spoke a little bit about that global sentiment. So the survey from Ipsos, who do a whole bunch of different countries and relatively high quality surveys, and just talking about saying, what was 2024 like. And so it was, came in at sort of not quite back to normal, but pretty close to back to normal in terms of was this a good or a bad year for people. And then the expectation sort of going forward then is not back to normal, I guess. So you're pretty close to back to normal on the part about, how did things go in 2024 versus 2025. But then when you look and say, okay, well, what about the expectations? So, for example, optimistic next year will be better than this year is 71%, versus the longer term averages of 75% on that basis. And then similarly for economic, it is looking like expectations are for a weak economy, and keeping in mind that that's some of those numbers include pandemics and things like that. I mean, just before the pandemic, it was sort of anyway, let's jump through to the next one. If you look then at retail investors, this is a little bit, you can get whatever story you want from this in terms of how you want to, what surveys you want to look at. If you look at the Conference Board and Bloomberg, they've got these measures in terms of US consumers never being so convinced. Excuse me, the stocks are going to rise. So you can see on these charts, or for anyone listening in, we've sort of got these charts that run back to the 1980s, and the consumer is expecting stocks to rise is at 55%. It's never been as high as that. The expecting to rise versus minus expecting to fall is sort of well over 30% at sort of levels it's never been at before as well. So that's I guess one part. So the other thing to sort of keep in mind with those, especially that stocks expecting to rise, over the long term, stocks rise. That's they're backed by the reinvestments and growing profits and things like that over a longer period of time. And so it is sort of a little bit, just looking at that graph on the right, it's a little bit strange that the average of sort of 35%, so a third of people are expecting stocks to rise in any one year, is sort of relatively pessimistic from the actual results of the last couple of hundred years. So that was those. Then we look at so that's sort of one measure of it. If you go back to the Federal Reserve Bank of New York, so one of the Feds that sort of operate specifically in the New York area, they run this survey about consumers, and they've got consumers sort of back at consumer expectations for stock markets, and they're basically saying, well, it's actually looking pretty low relative to where it's been in the history. Better than the last couple of years, obviously. So this is sort of the same levels that we saw in some prior years, and we've had some pretty good performances. So especially based on this, some of these negative years, in 2022, 2023, just before we're sort of getting these a couple of 20% plus years, and then if you want to look one more direction, so just to add one more, is there's this American survey of investors, and that sort of brings them back, and it says, well, they're about average relative to where they've been in the past. So I guess where I'm coming to from this is that investor surveys are interesting in some ways, but in many ways, without knowing the full details and all the intricacies and what people are thinking, how the questions are, and all that type of stuff like that, if you're investing solely on the basis of those, you wouldn't have done such a great job over the last considerable period of time. So it's sort of interesting in terms of when you often hear people talk about that investors are far too bullish or far too bearish or whatever the case is. But as you can see from these three measures, it's basically pick your survey and you can come up with the story you want for those. So that's sort of where we're sitting at from a sentiment point of view. We might go do a quick message and then I'll come back with the next step.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the next one I just wanted to focus in on before we start talking more about what are some of these predictions that's coming out is what's priced in into Australian markets and rate cuts, and in particular there's a considerable chance that we're looking at sort of a number of rate cuts across. This is what's the market pricing as of yesterday for ASX for the 30-day futures. So it's basically sort of you can think of it as a probabilistic weighted cuts. And so that's looking at saying, from 4.3, you're coming back to, three rate cuts by the end of the year, and they're basically flattening out from there. So sort of an expectation that, there's some rate cuts coming within Australia, but they're not going to be particularly deep. And this is actually ranked as one of the shallowest, cutting cycles we've been through. And I think that's probably a good sort of jumping off place for the expectations for markets, because what you'll see in a lot of different expectations is we're seeing interest rates being pared back from how far they're being cut. So we went through this cycle where inflation ran up, interest rates ran up right around the world. We've seen rate cuts for the last year, except for Australia. Now we're started talking about those rate cuts aren't going to be as deep as what was thought. So the US, for example, in 2024, the expectation was at the start of the year was that there might be 7 or 8 different rate cuts, and I think we had 3. So there is this there's this forecast going through, and we're seeing a lot of people coming out now saying, look, maybe the rate hiking cycle might be close to finished. Like there might only be 1 or 2 left before you reach that. And we're certainly seeing bond yields starting to reflect that higher amount on the back of the of expectations from Trump. And so, what are our thoughts on interest rates is that, look, there's the risks to Australia seems to be on the downside, and the risk to the US we would think is more on the upside. I think if we do see a concerted amount of spending coming out of the US and further, certainly taking the brakes off on the fiscal side, and tax cuts and all those types of things that have been suggested from Trump that is going to do, that then you're looking at fewer rate cuts within the US than what's priced in at the moment. The risk case to that is if something unexpected does happen. If he really does invade Panama to take over the Panama Canal or whatever the latest idea that he's had that he decides he wants to act on, some of those could make could put a serious dent in those expectations in terms of what's happening to the economy. But it does look like he's inheriting a pretty strong economy, and with this gentle sort of glide path as the economy is weakening, gentle glide path into which he's then going to throw a bunch more debt and a bunch more sort of expansionary policies, which is likely to result in fewer rate cuts. The issue for Australia is really, how much we tied to the US and how much we tied to China, and that's where we will see that. Our expectation is that you will continue to see some considerable fall-offs in China. The big one that does come back to one of the biggest questions out there is how high are these tariffs going to be in China? So as your prediction there is saying, well, is it going to be the 60%? That Trump has mooted? Is it going to be a much smaller number that gets sort of negotiated away with whatever whatever China is willing to give up? That's your major economic question, I think, particularly in terms of Australia, how that's going to affect it. So if you come in anywhere near the sort of 60% level, it's quite bad for China and very bad by inference for the Australian economy. Watching where those tariffs are going to be. Look, do we have a prediction on that? Look, our expectation is it's probably closer to the 60% than nothing. I think if it came in, anywhere between 40 and 60%, we're probably, we'd feel our portfolios are set up for that type of arrangement. If it ends up coming in higher than that, we're probably not too bad in terms of the way we're skewed. Coming in lower than sort of 40%, that's where we'll start to need to reassess, what we're doing from portfolio standpoint. And the lower you get, the more positive it is for Australia and probably elements of Europe as well in terms of that. So that's the tariffs is a big one. If you look through AI is your other major one, the other major boom going on at the moment. So look, the quote you get, and I've got one here from Jeremy Grantham, who certainly rate as a very thoughtful and intelligent observer of markets. But he sort of talks about saying, the AI, when you have these great developments, they overdo things in the short term, they crash in the intermediate term, and then they come out of the wreckage and change the world in the long term. And he's talking about the internet boom. He's talking about railroads, all that type of stuff, and is clearly throwing artificial intelligence into that same category. And so the real question, though, from this is, and coming back to that, he's not the only one talking about a crash in terms of AI. There's lots of predictions out saying AI's run too hard, it's not doing a good enough job, the results aren't good enough, and it's getting too expensive, and so there's a crash coming in terms of that. And they're probably right at some point. Is that at some point people will get too excited about the implications for AI and pricing will get too extreme. To date, we don't think it's run far enough. So typically, when you do run into these bubbles, they run really high, and the valuations get away from the earnings. And what we've seen certainly in the larger stocks is the valuations really haven't gone that far. We're talking about Nvidia's valuation for the second year out is sort of like 27 times earnings. And so I think first year sort of like low 30s. And so yes, they're certainly high, but they're not at such extreme levels you've never seen before. When we're talking about that whole sector, because the biggest stocks make up the most amount of value in that. When you do the sort of valuations on the whole sector, they come out looking expensive, but again, you're into the sort of 30s for PEs, whereas during like the tech boom, you might have got into the hundreds for companies. And so and you have seen a run up of some of the companies that are loss making, but they're still relatively small in the whole scheme of things. And so it's not like you've got this massive amount there. So from that perspective, AI, clearly a chance that people sour on it, and what we're watching most closely in that market is the Nvidia results, because we do think it's a bit of a bellwether for the sector. If you genuinely saw a major downturn in those results, or even just flattening of earnings for some time, that would probably put a reasonable dent and give the sort of the AI bears, I guess the impetus and we'd see stocks sell off on the back of the market tends to get hold of these narratives, and there's a bullish case and a bearish case, and if a few things go wrong, all of a sudden all you see everywhere is bears on the news, and so therefore the stocks sort of get pushed down a bit further than they should, and vice versa with the bulls. And so that's why we go through these cycles. But I guess the main thing I'd be focusing on, or the main thing we're focusing on, is the earnings for the bigger companies within that. And the other thing I wanted to note at the moment is, so they're still growing earnings quite strongly. Capital expenditures are high, but they're not debt-funded capital expenditures for the most part. So, and what do I mean by that? Well, the companies that are doing most of the expansion in terms of your Amazons and Facebooks and Googles and Microsofts all have pretty big cash reserves. And so they're not actually going out there and borrowing money in order to build these data centers with the expectation that future revenues will sort of bail them out. And that's where, because they're the cases where you do start to run into problems and I worry more about the consequences. So, the housing boom, we saw that, people borrowing money to buy houses because they thought it was going to keep going up, or whatever the case was. Or you're looking at railroad booms where you're borrowing money and then going out and building railroads. During the internet, there's lots of most of it was actually equity based, but there was still a number of sort of debt backed ones, particularly in some of the telecommunications space. And so they're the ones that cause more damage. And so not to say we won't get there for AI, but we're not there yet at the stage where we're seeing sort of massive lending into that sector to make it boom before we go. The other thing I wanted to jump and talk a little bit about was this idea of American exceptionalism. So, sorry. Before I get into that, the other factor for Australia, coming back to Australia, for 1 minute, is if you look at the Australian stock market, really, I think of it in sort of 4 categories that's sort of worth noting. Is you've got the resources and the banks, which make up the lion's share of the sector, sort of 60% or something of the sector. So that's the real big call on both of those, is to should I have banks or resources, or should I have something else? And you get that call right, and it pretty much doesn't matter what else you do within your stock picking if you nail that resources versus banks. So resources had a bit of a tough year last year. Banks had a great year. The question now is saying, well, if we're going into major Chinese tariffs, then it's probably not going to be a good year for resources. And despite the issues we had around saying big expansion in terms of electric vehicles, big expansion in terms of batteries, and all these types of things like that, we saw some pretty big falls in the lithium price, and then we also saw big falls in the iron ore price. And so the question for me on Australian resources is saying, what's going on in China? What's happening with those tariffs? And to date, it really, as we've spoken about on this channel many times, it really does look like the Chinese government has just been grandstanding, talks about what it's going to do, all these big fiscal expansions and all these things they're going to do to get the economy back and going. But none of that involves propping the property sector back up again. And so you get a short-term spike and then it falls back down again. And that's our expectation, is that we're going to see a bunch more of these throughout 2025, where the Chinese government will talk up the prospects, but the end result will be no follow through, and iron ore sort of keeps drifting lower. There's lots of iron ore projects undergoing at the moment, and it does look like demand is really slowing off in that sector. So yeah, that's probably the big one for us on the resources side. On the banks, look, we got 2024 wrong on the banks. We thought the banks were already started the year pretty expensive, and they outperformed quite substantially, and so now they're miles above any levels we've ever seen relative to banks around the rest of the world. Commonwealth Bank in particular, it's more expensive. If you look out 2 years, Commonwealth Bank's more expensive than Google. It's more expensive than Facebook. It's not that far off Nvidia. Like it just seems extraordinary, and especially when you look back at the earnings, like it's really not generating particularly great earnings growth. And so it's our view on banks is, look, it can't keep going up forever. You need to be supported by the earnings. They're not really seeing the earnings come through, or they're not seeing the earnings come through. And so at some point, the valuation is likely to come back. And so if you sort of exclude those, now you're talking in the rest of the market. You're right, and at that point, you're either the international sector or other. And when I say the international sector, I'm talking about companies that are listed in Australia, but are really overseas companies. Say, for example, CSL or James Hardie or companies like that, who are really international companies that happen to be listed in Australia, as opposed to sort of Australian domestic companies. And that's where we're sort of targeting most of our money is within those international ones. So that's the Australian market. Within international markets, again, there's this idea of American exceptionalism, and is this going to be the year where American exceptionalism comes to an end? And so if you look back for the last, basically since last 15 years, I've got here the chart just sort of showing the NASDAQ relative to the MSCI World, excluding the US. And so, if you invested in the rest of the world in 2000, you did way better than the US. You probably did 50% better than the US or more up until 2007, 2008. And from that point, though, it's been all US. Basically since the Lehman Brothers bankruptcy, it's been all US. And so, a dollar invested in the US versus a dollar overseas is probably, well, actually just from this chart, I'm not quite sure if this is right, but this chart's saying you're going to do 7 times. You would have done 7 times better in the US versus the rest of the world, or in the Nasdaq. Sorry. Now, some of that's an element of the Nasdaq being underpriced, but there's also a pretty big element of seeing that earnings growth, and I think that's what we keep talking about, is saying, needs to keep coming back to that earnings growth. So you look at a chart like this and you go, oh, that can't continue forever, and that is true. But the question is, can it continue for 1 more year, or 2 more years, or 3 more years? And so, and that's the key question, is that, it's not a point about looking at a chart like this and saying, here's a trend which can't last forever, and so therefore it needs to finish right now. You could have said exactly that same thing at any point in that chart along, from 2020 or onwards. At any point you could have made exactly that same argument. And so the question is, are we actually going to see the fundamentals get worse in the US? And that certainly hasn't been the case for the last year. Is what we've been seeing is just the US is certainly running ahead of its earnings. The stock market's growing faster than the earnings, but not that much faster. And you're certainly seeing better earnings in the US, far better earnings in the US than what we're seeing in Europe. I might just go to another message about how you can take advantage of some of those through some of our.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
So the last 3 things I want to run through comes from Ben Inca, who's GMO, and they're sort of just looking at some of their ideas for the market. They do a lot of asset allocation as well, and got a pretty good history of picking some bubbles. And so I think it's always worth having a look at what they're saying and sort of comparing and contrasting. So they've got sort of 3 main ones. One is value stocks. Now, this one I've got less. Well, this one I'm less excited about. So what he's saying is, if you look at the valuation of the cheapest 50% of the US market versus the average, it puts you at the 7th percentile. So it's basically saying, if you take all these value stocks, and value stocks tend to be ones that don't earn very much, they don't earn big margins. They're often commodity stocks, or stocks where the expectations are really beaten down. And so what you see within that is that, in a big picture sense, you want to buy value stocks when the economy is starting to take off, or actually, sorry, in the later stages of the economy taking off. Because what happens is at those later stages of economies, when you're in sort of these bigger bull markets and you're starting to get inflation, and central banks are starting to try and clamp down on inflation, these companies which have got very little pricing power finally get to start getting some price rises through. And so because that's the case at that point, that's when value stocks start to rally, because these companies actually start to get earnings coming through. Because often that's usually the problem with these, is they're priced very low, but they're just not getting the earnings. And so the issue right now for value stocks is, if you're looking at commodities and worried about big tariffs coming in terms of the US and what they could do for that market, is you probably don't want to be in those commodity markets. Energy is a big part of this as well. Now, energy, the real factor over energy now is Russia. So, and that's your 2025 prediction about where that's going to go or not. So if Russia, if we say, for example, we get what Trump says is going to happen, and I'm not convinced on this case that it will absolutely be the case, but let's go with it for the sake of this argument, is that he solves Russia, he solves the Ukraine. Maybe it doesn't take him a day, maybe it takes him a month or two, but you get some sort of resolution in the Ukraine. Then the question is, do you get Russia re-entering the market with its energy? And if it does, gas prices get hit, oil prices get hit. And so do you want to be out there buying oil stocks, right now because they're really cheap, with the specter that maybe Russia, steps back into the market? So that's your first issue is that energy stocks. You see, second one is a lot of these value ones as well. There's a lot of car companies in that. So if you exclude Tesla, particularly when you're looking around Europe, these car companies are dirt cheap. Like they're trading on 5 times earnings or 6 times earnings, and cheaper if in other cases. And that's the case in Japan as well. The Japanese market is dominated by some of those large car companies, and so the question for them is they're really facing a tough time from Chinese imports. And you're looking at a case where China might get slapped with some pretty significant tariffs, and those tariffs sort of then leading to further weakening of the Chinese yuan, and so makes Chinese exports even more competitive into other markets. So there's sort of some sort of large questions around those as well. So. And you can run through a few other the sectors that sort of fit into this category. But where I'm getting to is that just the fact that value is so cheap relative to history is not necessarily a reason for this year to be the year that it bounces back. And so you saw certainly a big run up in value for that coming out of the pandemic, where we started to see that inflation and these companies finally got to put pricing pressure back through. We're not expecting that in 2025, and so value stocks look cheap, but for us, it's a matter of trying to still sticking with quality. And the other one is, so he's got 3. That was the value stocks. The small caps with another sector that he highlighted, and so again, sort of highlighting that if you look at small caps versus large caps, that their pricing is now at the 4th percentile of where you've been over time. And again, I think there's an issue with these in terms of, are you seeing the earnings growth coming from them? And for us, we're really not. I haven't actually got the chart up of the small cap earnings, but for us, small cap earnings have been the disappointing part of the market. And to us, that's why we're seeing the continued that they continue to look cheap, because we're really just not seeing the growth out of that sector. Now that might change, and if that changes, small caps is certainly a bet we'd be willing to pivot to quite quickly. But at the moment, the earnings really have been led once again by those large companies within the market. If you're looking at the last couple of years, almost all the earnings growth that we're seeing is really coming from those big 7. And in a big picture sense, in terms of an absolute sense, but also when you start looking at the percentage growth rates you're getting within companies, the small cap sector has been disappointing. And it's one. So I guess what I'm saying is, it's one thing to say it's at the 4th percentile, but really trying to work out what's the catalyst to turn that around. And the expectation for me is you need a relatively strong economy, and that might be the case, but until we sort of see that coming through, that's sort of one we're happy to leave off the shelf as certainly an opportunity we want to take advantage of at some point, but not just yet. And it might happen in 2025, but then again, it might be a later story. It might not be 2026 or later before we sort of feel comfortable that we'd like to start digging into that theme. And the third theme he had is small cap Japanese stocks, or Japanese stocks in particular. That one we've got a lot more sympathy with. There's a number of Japanese stocks that are very cheap. There's also a lot of other car companies, as I said, who are cheap for a reason. But broadly speaking, Japan and Japanese stocks are trading significantly below where they have in the past. And we've also seen that some reasonable increases in the quality of what the earnings that we're seeing. So, the story, I guess, from Japan from the 1990s was that the companies there are indebted. They don't really care about shareholders. It's all about management and feathering each other's nests and cross shareholdings and all these factors like that sort of didn't lead to shareholder value. There's been a long, slow change within Japan, and much more focus on shareholder value, much more focus on and a long sort of focus. There has been a focus of getting out of debt, but there's been that long process of deleveraging these companies. And at the moment, the debt levels are reasonable. You're looking at a market where you're getting some reasonable return on equity and at prices that are very low relative to the history of where they've traded. So, we've certainly got some sympathy. It's not going to make up all your portfolio. You're still not seeing, for the most part, for those companies, you're still not seeing the same types of earnings growth that you're getting out of the US, for example. But you are seeing some pretty reasonable numbers that we'd sort of put on our path as being, worth the investment within that. Anyway, that's a bunch of different themes that we're seeing out there. Just a reminder for everyone that if you want to get more of our content, nucleuswealth.com, you can sign yourself up and get on our mailing list. If you want to get us listen in, we're at 12:30 live every Thursday, and you can drop in any questions on the podcast. If you've got any of the you can get us on a whole bunch of different podcast platforms, Spotify, Apple Podcasts, all that type of stuff, and we're on a bunch of different social media. So hit the like and subscribe button, and look forward to seeing everyone next week.